Happy Friday. It's incredibly hard for me to believe that this is the start of Memorial Day weekend. I'm guessing that a lot of us are starting our weekends a little bit differently than we originally planned. I am here and I am so excited to be able to introduce our guest today. Mr. Scott Martin is joining us. He's the Chief Investment Officer at Kingsview Partners. He's also been a major contributor for Fox News and the Wall Street Journal, as well as many other publications. And personally and very successfully, he's been managing and consulting on my own money for the last 7 years. Scott, thank you so much for being here.
Amanda, good to see you, and thanks for asking me.
Absolutely. Well, I'm going to just dive right in and make really good use of our time because I've got so many questions for you. You have been in the industry now for almost 20 years. Like me, that means that you have weathered and seen a lot of different crises in your world. How is this pandemic different or similar to a crisis that we've seen in the past?
Yes, and I look a little weathered too. So the years are starting to show as my hair grows out and gets grayer and grayer, whiter. So yeah, what's funny about that is I think kind of contributing to those factors on myself there, Amanda, is the fact that we're in another kind of market crisis, or at least have been. And maybe in that slight period of recovery, or maybe even a little euphoria, even as kind of states and the economy get back to normal here. So look, in being in the markets, as you mentioned, in the role of a financial advisor, wealth manager for 20 years now, we've seen these problems before. I hate to sound kind of banal and benign about it, but the reality is, and we were talking about this a lot, you and I were even in March, about how, yes, these crises are different. Every single recession, every single contraction, you know as well, every single pullback in the real estate market is different from the last one. It's caused by different factors. It lasts a longer or shorter period, has different price movements. But the reality is there's a lot of similar things emotionally that go on in these periods of time, whether it is the COVID pandemic, whether it was the Brexit vote just from, say, a few years ago when Great Britain voted to leave the Eurozone, when it was the Greek debt crisis, when they were messing up the EU with all the borrowing they were doing and not paying the money back, the financial crisis of 08, even some of the tech stuff back in 01. I could go on, and we've only talked about the years I've been in the business. So the reality is this, the emotions are definitely the same this time around as they have been with previous crises. And that's one thing as investors, we have to remember that you really don't want to panic in times like these. And you want to actually use panic, which has been out there this time, certainly in February, definitely in March, to your advantage as an investor, because panic, in our opinion, as investment managers at Kingsview, Amanda, creates opportunity. It creates the opportunity to really know where your risk profile is. It creates opportunity to see if you can buy some stuff that you've always wanted to own at lower prices. And it also gives you a chance to really see how you feel about markets, and when they move and shake like they have been in the last couple months, how you feel as an investor with respect to what you own, and if you need to change any of that stuff up going forward.
Super. And that's probably a really great lead-in for my next question. I know in real estate, when we get into more turbulent times, it feels like the investors start coming out of the woodwork and they're looking for opportunities, looking to see if there's a good time or good something that they can find out of this type of crisis. Is this true with your side of the equation as well with regards to financial investments?
Yes, we actually love it to some degree, because even though some of the lore or conjecture on Wall Street is that these are just bottom feeders, or they're just vultures. They want to come out and take people out when they're in the worst spots possible. And I think similarly, I've heard some things about real estate, but the reality is this: those are liquidity providers. I mean, those are people, entities, corporations, whatever they may be, that will take somebody out if they want to sell, granted, and give the liquidity that the markets need. Because what we saw, Amanda, with certainly the pullback in March, as we saw in the financial crisis of 08, and even the tech crash in 2001, is that there were liquidity issues. The markets get very volatile and very wild when it doesn't feel like all the participants are there, or when you say, hey, I want to sell a Coca-Cola stock at 40 and you can only sell it at 38. I mean, somebody needs to come in and bridge that gap and say, hey, I'll give it to you for 39. And Coca-Cola obviously is more volatile, or less volatile rather, than maybe a bond in JP Morgan, but it still has the same kind of theme with respect to seeing how the liquidity that's provided by any market participant that comes in and provides it is actually a value to the market, because as that started to happen in March, when some of these quote unquote vultures or opportunists came in and bought some stuff lower, we admittedly were one of them that just saw things at a really good price, and we wanted to come in at some times and buy things. That actually starts putting in that bottom for the market, because once the liquidity returns, that's when prices can normalize and start to act a little bit more like they should.
Sure. No, that makes a ton of sense. Okay, and this is another field where I think our two industries have a lot of similarity. The media. The media puts us on a roller coaster, and as I always say, it's either fear or excitement that sells publications. So if I take myself, and I consider myself a minorly educated consumer in your financial world, I don't need to be anymore, because I could trust somebody like you to manage all of that for me. What do I believe? Because if I jump on every headline, then obviously I'm putting myself back into that emotional turmoil that you just talked about. So what should I believe?
Well, I think you have to believe what's kind of in your heart. And like you said, some trusted experts that I believe, Amanda, know you, because that's one thing that I see a lot too. And look, I'm guilty of it, of checking the headlines, checking Twitter, and just seeing what's going on. And obviously, in most cases, at the end of those exercises, I feel a lot worse afterwards than I did going into seeing them happen or reading about this stuff. So you have to realize that there's a lot more that applies to you locally, let's say, or in your particular situation, something that an advisor can advise you on that CNN or somebody else can't. And there's that old kind of saying in media, you mentioned that I do a lot of Fox News and a lot of Fox Business commentary on the markets and economy. If it bleeds, it leads. If it stinks, it sells, something like that. I kind of just made that second one up, but there's not a motivation to tell people that things are going to be okay, unfortunately. So knowing that too, and knowing that I am at heart an optimistic person, I try to do what I can. I try to do what I can to help others as well. I feel like having that comfort of realizing that there is a motivation in some of those media outlets, whatever they may be, and whatever people are posting and writing about. And so you don't take it too seriously, but you do take seriously the ones who are close to you in that circle, whether it's a trusted accountant, a trusted wealth manager, as you said about me, a trusted attorney, all things that is estate planning wise, all things that are very near and dear to you are the most important things, and maybe not so much what you see on TV, read on Twitter, or read in the financial press.
Great. Okay, so one of the conversations that I've found myself having a lot lately, and I have had people turning to me, is the idea that people are sick and tired of riding the roller coaster of the financial markets, and they just want to cash out, put their money elsewhere. Some people have come to me and said, hey, I want to buy investment property now. What do you think of this strategy? And once again, I know I'm asking you a very generalized question without knowing people's specifics, but is there a point in time when that makes sense to somebody, or is that just crazy talk?
It does make sense. I think for a time, for everyone. And I think everybody, it's understandable. I think everybody goes through those emotions of this euphoric to concern, to despair, to where you want to kind of feel those out and see how they treat you to know kind of what your reactions are going to be and your gut reactions. But I mean, Amanda, I'll tell you, I mean, having the markets fall close to 30%, depending on your favorite index, off the highs in January all the way down to March, was unnerving for a lot of folks. And granted, you, depending on what you owned, you didn't maybe feel all that 30%, and maybe you did, and maybe you felt worse than your neighbor. But sometimes there is that reason, and I'm kind of a de-risker and a risk manager at heart, to just take a step back and take a deep breath and take some time, which includes getting out of the market, or say, like you talked about with the investment property, maybe passing on the investment property to see if things settle down, because there's always time to get back in. I mean, there's always time that the market is going to give you more opportunities. The only thing I would warn people about, though, is if you're taking off a lot of capital, or you're taking off a lot of assets that maybe result in like a tax situation where you're going to have long-term or short-term capital gains, or if you're doing it more in a timing sense of saying, well, I'm going to take off a majority of my portfolio on Friday, and then I'm going to buy back in on Tuesday. And then when the markets go back up on Thursday, I'm going to sell on Tuesday. You know, you kind of get into that kind of dog chasing its tail kind of motif, and you lose track of really what that money is there for, because there's just a few things to remind ourselves as investors, is that stocks are positively sloped. They go up over time. Now, they do look like an EKG sometimes. They do look like your favorite roller coaster, I think you said earlier, at times. but the reality is stocks do go up over time. And the reality is too, with bond investments, which pay an interest income or have some yield on them, they typically do okay over time as well, depending on the credit quality of the issuer. So having a mix of those two things in your portfolio, again, depending on your risk profile, and knowing and being, I guess, confident in that mixture and confident, hopefully an advisor that can put that stuff together for you, I believe is a lot better path to success than trying to time the market often.
That makes a lot of sense. Okay, so obviously there's been a lot of projection and discussion about what a recovery from COVID-19 will look like. There's been a lot of discussion of all the L shapes, the U shapes, the V shapes, the W's, the check marks, just about everything. In your professional opinion, how do you see this playing out over the next year, 2 years, 3 years?
Another example of one, I've heard two new ones actually in the last few weeks. And actually one of them is from one of our guys, which is the Nike swoosh. I believe he was one of the first ones to say that. So shout out to Paul, who's on my team on that one. And that might be the right kind of symbol, Amanda, or the one I've heard, which is kind of gross, is the bathtub, where you kind of just like slide in there and it's long. And then the upside isn't, there's just not very much upside on each side, kind of like, unlike the U, which is really deep. Sure. So I think it's one of those three, maybe the U being more likely, in the sense that the markets and economy round out this bottom, things start to get better, or in my case, I believe, start to get less worse. And then the markets start to heal themselves. The economy comes back, consumer confidence come back, and then things return to normal. What I will tell everyone that's thinking about investing and how you do this, remember that the markets and economy don't always dance together, but they're on the same dance floor, meaning that they hear the same music, but they aren't always going to move in lockstep. And so by that, the economy could still be lagging some, Amanda, this summer, but the markets could already be well on their way to recovery because they anticipate a lot of what's coming, and vice versa, as the markets could already turn down again if we say have another economic shock. So just remember to keep in mind that if you're waiting on data, if you're waiting on things to come out and exactly tell you X, Y, or Z, sometimes the market will preempt some of those data points that are likely to come out.
Sure. Okay, and now once again, this is another question that I am prefacing that I am putting you in a terrible position because I know in my world it's very unfair and hard to talk in generalizations. But where we are today in the financial markets, in the economy, in the COVID situation, what's the one best piece of advice you would be giving your clients right now?
I would tell them to really dial in what they're expecting and looking for when it comes to goals in their lives as far as investments. Because one thing that we've learned, even just in the last several years, is that the markets are great places to invest. And there's certain parts of the markets in real estate, in fixed income, in commodities like gold, for example, in equity stocks, the equity positions in stocks that are very good at times and not so good at times. And one thing that you have to kind of, I believe, dial in, and a reminder when you do this is when you see what can happen in markets, when things, as we talked about earlier, when things can just get really separated from the standpoint of what they're really worth and what somebody's willing to pay for them. And so just kind of keep in mind your goals and your aspirations for your money and your ability to save money and all the things financially that you kind of have to keep in mind right now, especially given that, COVID was such a scary time. And for a time there, it felt like it was going to sweep the nation and really attack everyone. And just because it hasn't by now doesn't mean it won't. So we have to think about not only our money, our assets, our investments, but also some of the estate planning, the wills, the trust, whatever else you need to set up, insurance that is just beneficial for your whole financial life, so that if there's another crisis or something else that happens in a handful of years, maybe if you panic this time around, you're not so panicky the next time around because of what you did as a result of this time.
That's a great piece of advice. Although I will share, I remember years ago, you gave me one piece of advice that you may not even remember now. And I think part of it is just who I am, why you gave me this advice. And my goals for my finances. But I remember at one point we were going through a downturn and you said, Amanda, just do me a favor and don't open your statements up. Don't open the statements up because we know what the plan is. We know what we're doing, and no good will come from you getting nervous about what those numbers say right now. And that was still to this day one of the best pieces of advice that I've taken, and not putting myself on more of an emotional roller coaster.
I
obviously
think I got it from a fortune cookie, but I'm glad that worked out. And I think a fortune cookie from like Wendy's or something. But it's funny because you're right, though. That's where that emotion, though, Amanda, comes into play, and it works against you sometimes because the emotion can take over the rationality of thinking and therefore lead you into making some really bad financial decisions.
Sure. Okay, now the one question that I'm asking everybody that dares sits with me. We have all taken on new skill sets in this pandemic lifestyle. I have learned to cut hair. I've learned to do laundry, which was something I couldn't do before.
Wow. Congrats.
Right. What is the one thing that you would say, a skill that perhaps you've mastered over the last 2.5 months that you didn't have before?
Well, I have learned not to cut hair, clearly, because my hair is not cut at the moment. It will be soon, I promise. Maybe when we come back around sometime, we'll see the fruits of that labor. You know, I've learned that, actually, man, and this is going to sound cheesy, that I really do appreciate kind of the simple things in life. And we get distracted with kind of the everyday hustle and bustle. I mean, you and I both live in Chicago. We live in the city. And there's just a lot going on, both really in our lives, but other people's lives with whom we're connected. And those are just things that I believe as humans, we just get caught up in. I get caught up in news flow. I get caught up in being on TV. I get caught up in being at this party or being seen somewhere. And, you know, I've realized that I really enjoy a lot of the simple things in life. And I kind of am appreciative and grateful of the reset, if you will, that the COVID kind of containment has brought me, because I'm back down to playing a lot of games with the kids and playing old video games with my son, and we're throwing the ball around. And that, unfortunately, that's, I guess, the highlight of our day, but we're also grateful that that's the highlight of our day, and making grilled cheeses together and things like that. And that's stuff that we did sometimes, but we didn't do it as often, and I didn't really enjoy it as much as I do now. So it really is a nice reset button of the simple things in life. I think that a lot of us return to really do give us the true pleasure that we look for.
Awesome answer. And I think it's especially a great one going into Memorial Day weekend, in which we're all kind of experiencing a little bit different downtime from whatever it is. So on that note, I will remind everyone to be kind to one another, be kind to yourself, take care of one another, take care of yourself. I think this weekend is going to be a real test for a lot of people in terms of their social distancing. So please do your part. We are doing well. I am so grateful to be a part of your journey and for you to be a part of mine. Scott, thank you for all that you do in this. Be well, people, and I will look forward to seeing you again tomorrow.